One of the most notorious criminals of the 21st century, the mastermind behind the largest financial market scheme in history, Bernie Madoff defrauded countless investors out of billions of dollars. Madoff's Ponzi scheme, which ran for decades and went undetected by authorities, is a cautionary tale of greed, deception, and criminality. How did he manage to pull off the biggest financial fraud in history?
His ability to tell credible lies helped him build the $65 billion fraud that ruined tens of thousands of people's lives. His lies were devastating, even deadly. At least 2 investors committed suicide when they learned of their Madoff losses.
Bernie Madoff's massive Ponzi scheme started in the early 1990s when he began to solicit investments from wealthy individuals, hedge funds, and financial institutions. He promised them returns of 10 to 12% or more, using a complex financial strategy that was difficult to explain. In reality, there was no complex strategy. Madoff was simply taking money from new investors to pay off the earlier ones. This is the essence of a Ponzi scheme, and it allowed Madoff to grow his investment business quickly, as more and more people were enticed by the lucrative returns he was offering. At first, Madoff was able to get away with his scheme because he had years of experience as a Wall Street trader. He was able to fool investors into believing that he was an expert at managing money, and his impressive portfolio of investments backed up his claim. What investors didn't realize was that Madoff was simply taking their money and spending it on himself and his family, rather than investing it in the stock market. Eventually, however, his web of lies began to unravel as some investors began to question why their returns weren't what they were promised. When Madoff could no longer come up with convincing answers, the truth eventually came out, and he was exposed as one of the most notorious fraudsters in history.
So here's how it would work. Here's Madoff, and he'd have investors, let's say 5 of them, and he was offering them between 10 and 12% a year. But he may not have actually been doing anything to generate that return. The way you pay those people their interest every year is you go to another investor who will provide money so that you pay it off. Basically, that's a Ponzi scheme. You're using new investors to pay off the returns of old investors. Well, what happens then is now he's got more investors because that one that he got the money from is now one of his investors, so he has to go and get more people. This continues to work because what tends to happen is people get a consistent return on their money, so they don't take it out after they get their 12 or 15%. They put it back in. They keep on going.
Bernie Madoff's Ponzi scheme was one of the largest financial scams in history. It was a sophisticated form of fraud which promised investors incredible returns and managed to fool many people. The scheme itself was quite simple. Madoff would solicit investments from new clients, promising them returns of between 10% to 12% or more. He would then use those funds to pay out returns to existing clients, making them believe that their investments had grown exponentially. In other words, Madoff was robbing Peter to pay Paul. At first, Madoff was able to pay out these impressive returns by taking a percentage of money from new investors. But eventually, as his Ponzi scheme grew, he could no longer sustain this level of return. To make up the difference, Madoff started to use funds from new investors to pay the promised returns to existing investors. To further complicate matters, Madoff would often borrow money from banks and use it to fund his Ponzi scheme. This allowed him to keep paying out the promised returns for much longer than he otherwise would have been able to. He also created a complex network of offshore accounts and companies to hide his activities and evade taxes. Ultimately, Bernie Madoff was able to use his Ponzi scheme to swindle billions of dollars from unsuspecting victims over a period of several decades. His ability to deceive investors and stay one step ahead of the authorities is what made his scam so successful and lucrative.
He had a wonderful set of skills for a Ponzi schemer, for a con artist. He was, unlike most Ponzi schemers that I've covered, not charismatic, not charming, not a bon vivant. He was never the most charming person in the room. He made you feel like you were the most charming person in the room.
Yeah, now explain that. I mean, he would make you feel good about yourself and smart about yourself, and therefore so smart that you would invest with him.
Exactly.
Yeah.
So you would never doubt your judgment about trusting Madoff, because Madoff made you feel like you were a genius too. So when I interviewed him in prison in August of 2010, I have to admit, he made me feel like I was the most interesting, intelligent reporter he'd ever met in his life. He had that magic. It really is amazing. He also had another gift that I think got under people's defenses, and that was he made you feel safe. And as markets got scarier, more volatile, more turbulent, more complex, all these derivatives and all these fancy products, Madoff made it simple for you, and he made you feel safe. So unlike the typical Ponzi scheme that tended to exploit people's greed, Madoff exploited people's fears. He made you feel like he could keep you safe in this increasingly frightening market, and that drew an awful lot of conservative investors to him, thinking that they were giving up high-flying returns to get the safety and consistency that Madoff gave them.
Bernie Madoff's massive Ponzi scheme was kept afloat for years thanks to a few key factors that enabled him to avoid detection. For starters, Madoff was an expert in exploiting loopholes and avoiding regulation. He kept many of his accounts offshore, which made it difficult for regulators to scrutinize the details of his transactions. Additionally, Madoff had a well-developed network of powerful and influential contacts, including bankers, hedge fund managers, and other financial professionals. These contacts helped him cover up his fraudulent activities, while also providing him with access to more victims. Furthermore, Madoff used a sophisticated system of accounting that allowed him to hide his tracks. He used several different sets of books, with one set being used to track his legitimate investments, and another set being used to record the money he was siphoning off from his investors. Additionally, Madoff spread his money across several accounts in an effort to make it more difficult to trace where the money went. The paper trail of victims' claims demonstrates the depth and breadth of Madoff's betrayal of investors. Documents show that Madoff's scheme lasted more than 5 decades, beginning in the 1960s. His final account statements, which include millions of pages of fake trades and shady accounting, show that the firm had $47 billion in profit. Finally, Madoff preyed on investors who were too trusting or naive, which meant that they weren't likely to question the legitimacy of his investments. Additionally, because Madoff had a long history in finance, many investors assumed that his investments were safe and trusted him implicitly. This combination of factors allowed him to keep his scheme running for years without detection. The SEC had been investigating Madoff and his securities firm on and off since 1992, which frustrated many after he was finally prosecuted because it was felt that the most damage could have been avoided if the initial investigations had been thorough enough.
My 9-year-long investigation into the Madoff Ponzi scheme. I look forward to explaining to Congress today and the SEC's Inspector General tomorrow what I saw, when I saw it, and what my dealings with the SEC were that led me to this case being repeatedly ignored over an 8.5-year period between May 2000 and December 2008. And I will do my best to inform you, the victims, about my repeated and detailed warnings to the SEC. You, above all others, deserve to know the truth about this agency's failings, and I will do my best to explain them to you today. My team and I tried our best to get the SEC to investigate and shut down the Madoff Ponzi scheme with repeated, incredible warnings to the SEC that started in May 2000 when the Madoff Ponzi scheme was only a $3 to $7 billion fraud. We knew then that we had provided enough red flags and mathematical proofs to the SEC for them where they should have been able to shut him down right then and there at under $7 billion. But, unfortunately, the SEC staff lacks the financial expertise and is incapable of understanding the complex financial instruments being traded in the 21st century. In October 2001, when Madoff was still in the $12 to $20 billion range, again, we felt confident that we had provided even more evidence to the SEC such that he should have been stopped at well under $20 billion. And again, in November 2005, when Mr. Madoff was at $30 billion, 29 red flags were handed to the SEC, and yet again, they failed to properly investigate and shut down Mr. Madoff's operation. Unfortunately, as they didn't respond to my written submissions in 2000, 2001, 2005, 2007, and 2008, here we are today. A fraud that should have been stopped at under $7 billion in 2000 has now grown to $50 billion.
One of the first whistleblowers was financial analyst Harry Markopolos. He calculated in an afternoon in 1999 that Madoff had to be lying. In May 2000, he filed his first SEC complaint against Madoff, but the regulator ignored him. Markopolos wrote to the Securities and Exchange Commission in 2005. Madoff Securities is the largest Ponzi scheme in the world. Because there is no SEC reward payment due to the whistleblower in this case, I'm basically turning this case in because it's the right thing to do. Using his mosaic theory, Markopolos discovered several irregularities. Madoff's firm claimed to be profitable even when the S&P was declining, which made no mathematical sense given what Madoff claimed to be investing in. According to Markopolos, the biggest red flag was that Madoff Securities was earning undisclosed commissions instead of the standard hedge fund fee. The investors who pony up the money don't know that Bernie Madoff is managing their money. Markopolos also discovered Madoff was seeking large loans from European banks, which seemed unnecessary if Madoff's returns were as high as he claimed. It was not until 2005, shortly after Madoff nearly went bankrupt due to a wave of redemptions, that the regulator asked Madoff for documentation on his trading accounts. He compiled a 6-page list. The SEC drafted letters to 2 of the firms listed but did not send them, and that was the end of it. The lie was simply too big for the agency's limited imagination. In 2008, the SEC was excoriated for its slow response to the revelation of Madoff's fraud.
What the heck went on? Your mission, you said, was to protect investors and detect fraud quickly. How'd that work out? What went wrong? It seems to me with all of your investigators and all of your agency and everything that you all described, one guy with a few friends and helpers discovered this thing nearly a decade ago, led you to this pile of dung that is Bernie Madoff, and stuck your nose in it, and you couldn't figure it out.
Bernard L. Madoff Investment Securities LLC reported year-to-date returns of 5.6% in November 2008, while the S&P 500 dropped 39%. Madoff became unable to keep up with a flood of client redemption requests as the selling continued. According to the account he gave Fishman, Madoff confessed to his sons, Mark and Andy, who worked at their father's firm, on December 10. The afternoon I told them everything. They immediately left. They went to a lawyer. The lawyer said, "You have to turn your father in." They went, did that, and I never saw them again. On December 11, 2008, Bernie Madoff was arrested. Madoff insisted he acted alone, despite the fact that several of his colleagues were imprisoned. Mark Madoff, his elder son, committed suicide exactly 2 years after his father's fraud was exposed. Several of Madoff's investors committed suicide as well. Andy Madoff died of cancer in 2014 at the age of 48. In 2009, Madoff pleaded guilty to 11 federal felony counts in 2009, including securities fraud, wire fraud, mail fraud, perjury, and money laundering. He was sentenced to 150 years in prison and ordered to forfeit $170 billion. The U.S. Marshals auctioned off his 3 homes and 4 boats. On February 5, 2020, Madoff's lawyers requested that he be released from prison early, claiming that he had a terminal kidney disease that would kill him within 18 months. Bernie Madoff, prisoner number 61,727-054, remained at the Butner Federal Correctional Institution in North Carolina until he died on April 14, 2021. This is the story of the Wall Street monster who ran a $64.8 billion Ponzi scheme. Click the video in the end screen to see the crypto golden boy who built his cryptocurrency exchange into a $32 billion giant scheme in just 2 years.